You see the headlines every single day, don't you? One major company announces another round of layoffs. At the same time, you hear that the national debt has just surged by another $1 trillion. On the surface, these seem like two totally separate problems in our economy. But what if I told you they're not separate at all? What if they are actually two powerful currents merging together, creating the perfect storm for a market that most people completely ignore? We're going to talk about silver today because the data is screaming that something seismic is building just beneath the surface. Now, I know what you're thinking. That sounds like a really odd question. What on earth could the struggles of the American worker have to do with the price of a precious metal? The connection seems non-existent, but stick with me, because the link between these two is far more direct and far more powerful than you can imagine. We're going to connect the dots today. And by the end of this, you'll understand how these two forces are locked in a kind of dance that could be about to completely reshape the silver market as we know it. All right, so to really grasp what's happening with silver, we first need to zoom out and look at the bigger economic picture. And right now, that picture is defined by two massive opposing forces that are colliding. On one hand, you have a labor market that is flashing some very serious warning signs. And on the other, you have government spending that has become completely unanchored from reality. Just imagine two tectonic plates grinding against each other. The pressure is building, and it has to be released somewhere. Let's start with the jobs picture. Look at this number, 153,074. That's not just a data point, that's the population of a decent-sized city. And it represents the number of people who lost their jobs in a single month this past October. To put that in perspective, this was the single worst October for layoffs in over 22 years. This isn't a small crack. This is a clear signal that the economic engine is beginning to seize up. And this wasn't some gradual slowdown that we could see coming from a mile away. No, it was an explosion. The number of layoffs surged by a jaw-dropping 175% compared to the very same month last year. When you see a jump that sharp, that fast in just 12 months, well, that's not just a warning sign anymore. That's a 5-alarm fire for an economy that depends almost entirely on people having jobs and spending money. And this pain isn't contained to just one corner of the economy. It's spreading. We're seeing massive cuts in warehousing and transportation, the very backbone of the e-commerce world. The big tech giants, once thought to be invincible, are shedding workers, and even the government is tightening its belt. When you add it all up, we are now looking at over 1.1 million layoffs so far this year. That puts us on a path that we haven't seen since the absolute darkest days of the 2008 financial crisis. Now here is where the story takes a truly bizarre turn. You would think, logically, that if the economy is slowing down and people are losing jobs, the government would maybe try to get its own spending under control, right? But what's happening is the exact opposite. As the private sector is being forced to shrink, the government's debt is expanding at a rate that is nothing short of historic. Just try to wrap your head around this. During the recent 43-day government shutdown, the U.S. national debt still increased by $620 billion. Let me break that down for you. That's over $14 billion in new debt added every single day, while the government was supposedly closed for business. It's like the debt machine is on autopilot, and the only button it has is accelerate. And all of this came to a head in October, which clocked in as the single worst monthly budget deficit in the history of the United States. $284.4 billion of red ink in just 31 days. Now let me ask you, when you see an economy that's clearly weakening on one side and a government printing money at this breakneck pace on the other, where do you turn for safety? You start looking for a safe harbor. You look for real, tangible assets, things that politicians can't just create out of thin air. So we've established these two massive economic forces, a weakening consumer and a government with the printing press on full blast. How does this actually impact the price of silver? Well, this is where things get really interesting, because these forces aren't pushing silver in one direction. Instead, they are literally tearing the market in two,
creating what we can call a great divergence between two very different kinds of demand. And understanding this split is absolutely crucial to understanding the entire setup.
You can already see the market starting to sniff this out. While the stock market has had a pretty good year, silver has been on a quiet tear, up an incredible 84%. But here's the real story, the detail that matters most. It's not just that the price is up, it's where the price is highest. Physical silver in Shanghai is trading at a significant premium to the price in London. What does that tell you? It tells you that the factories, the industrial users in Asia, are desperate. They are willing to pay more, right now, to get their hands on the actual physical metal.
And that brings us right to the heart of this great divergence. On one side of the equation, you have consumer demand. Think about it. When 150,000 people lose their jobs in a month, what's the first thing they cut? Discretionary spending. People stop buying silver jewelry, fine silverware, and even investment coins and bars. That side of demand is getting crushed. But on the other side, you have a completely different story. A relentless, non-negotiable, and absolutely critical industrial demand.
This is where we need to understand a really important economic concept. It's called inelastic demand. It's a simple idea. Unlike a consumer want, an industrial need for silver is not optional. The entire green energy revolution and the future of high-tech runs on silver. You simply cannot build solar panels, electric vehicles, AI data centers, or 5G networks without it. This demand isn't driven by price, it's driven by pure necessity. The factories have to buy it no matter the cost or they shut down. Okay, so what happens when you smash these two forces together? What is the mathematical result of collapsing consumer demand meeting relentless, inelastic industrial demand? The answer is something called a structural deficit, and the key word there is structural. This isn't a temporary hiccup or a one-time event. It's a permanent imbalance that is baked into the market, and it's programmed to get worse and worse over time. You don't have to take my word for it. The data from the Silver Institute lays it all out in black and white. For next year, the world is projected to demand 1.2 billion ounces of silver. The problem? The world's mines will only produce about 1.05 billion ounces. That leaves a massive 150 million ounce shortfall. Think of it like your personal finances. The world is spending far more silver than it's earning. To make up the difference, it's been forced to drain its savings account, the above-ground stockpiles. And this has been happening year after year, with the deficit growing larger each time. This brings us to the inevitable, logical next question. You can't run a deficit forever. That savings account, those above-ground stockpiles, they're not infinite. So what happens when this relentless structural deficit finally chews through all the easily accessible silver? What happens when the warehouses that supply the world's industries start to run empty? The answer is a phenomenon known as a free float collapse. It's the endgame scenario. It's what happens when unstoppable demand meets an immovable object, a finite supply. The best analogy is a bidding war at an auction for the last bottle of water in the desert. When factories absolutely must have silver to keep their assembly lines moving, and the vaults are bare, price becomes the only mechanism left to decide who gets it. A frantic bidding war can begin, and the price is forced to rocket upwards simply to ration out the last few remaining ounces. Now, I know this might all sound a bit extreme, like some far-fetched theory, but it's not. The reality is, we have seen this exact movie play out before. There is a very clear historical precedent for this kind of setup, and by looking at what happened in the past, we can see a potential roadmap for the future. A future where the same forces are at play, but this time on a much, much grander scale. Just take a look at this comparison. Between 2008 and 2011, we saw the exact same dynamic. The financial crisis crushed consumer spending, but industrial demand, especially from emerging markets, kept chugging along. The Federal Reserve was printing money like crazy. And what happened? The price of silver went on an explosive run from around $8 an ounce to nearly $50. Now look at the situation today. The fundamental conditions are identical, but all the numbers are on steroids. The supply deficit today is 5 times larger. The pace of money printing and debt creation is at least 10 times worse.
The setup isn't just similar, it is profoundly more extreme.
So if history is any guide, how could this actually play out? Well, here's a potential three-step roadmap. First, you get the final shakeout. More bad economic news hits, it scares the smaller retail investors, and they sell their holdings, pushing the price down temporarily. But then comes phase two, the most important part, the industrial bid. The big players, the factories who are desperate for physical supply, they see the lower prices as a gift. They step in and start aggressively buying up everything they can find. This creates the physical shortage that leads to phase three, the recognition phase. The story of the shortage finally hits the mainstream media, everyone suddenly realizes the game has changed, and the market is forced into a rapid, almost violent repricing just to catch up with the new physical reality.
And that's why you hear people talk about much higher prices for silver. It's not just about a wild speculative guess. A price of, say, $100 an ounce ceases to be a moonshot, and it becomes something else entirely. It becomes the logical, conservative clearing price. It's the number that's mathematically required to bring a fundamentally broken market back into balance by forcing demand down to a level that matches the available supply.
So let's just pull all these threads together one last time. First, you have mass layoffs that are crushing the consumer discretionary side of silver demand. Second, at the exact same time, you have runaway government deficits and debt that are pushing savvy investors toward the safety of hard assets. Third, this is all happening while a non-negotiable, inelastic industrial demand is relentlessly eating away at a shrinking supply, creating a massive structural deficit. And finally, we know from recent history that this precise combination of factors has the potential to lead to an explosive repricing event.
And so this leaves us with one final critical question. When you step back and look at all the evidence objectively, the job losses, the record deficits, the premiums being paid for physical metal, and the undeniable math of the structural supply deficit, you have to ask yourself, in a world where industrial demand is a necessity, is a major shockwave in the price of silver not just possible, but perhaps inevitable? The data is certainly pointing in a very clear direction. Thank you for tuning in to the Bullion Signal podcast. We're here to help you navigate the macro landscape and protect your wealth. If you found this analysis valuable, please consider liking, sharing, and subscribing so you don't miss our next update. Just a quick reminder, this content is for informational and educational purposes only. It is not intended to be personal financial or investment advice. You should always conduct your own research and consult with a professional before making any financial decisions. Your financial future is your responsibility.